You were probably told that if you work hard, save your money, and put it in a bank, you are doing the right thing. It sounds responsible, safe, and smart, but what if that belief is quietly costing you thousands of dollars over your lifetime? What if the very system you trust to protect your money is designed, from the ground up, to profit from you losing? That idea feels uncomfortable, even shocking, and that discomfort is exactly why most people never look deeper. Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. Let's start with a simple question that most people never ask. When you put your money in a bank, whose money is it really? You might think it's still yours, just stored safely. But legally and practically, that money becomes the bank's tool. They owe you a promise, not a vault with your name on it. This small distinction changes everything, and once you understand it, you can never unsee how the game actually works. To understand why banks almost always win, we have to go back in time. Long before apps, credit cards, and online banking, early banks were simple storage places for gold and silver. People deposited valuables for safekeeping and received paper receipts. Over time, bankers noticed something important. Most people never came to withdraw all their gold at once. That realization sparked a quiet revolution that would shape modern finance. Banks began lending out some of the gold they were supposed to be guarding, charging interest on money that wasn't truly theirs to begin with. This practice became known as fractional reserve banking. It sounds technical, but the idea is simple. Banks keep only a fraction of deposits on hand and lend out the rest. That means your deposited money is working for them, earning them interest, while you receive little or nothing in return. At first, this system helped economies grow. Businesses could borrow, trade expanded, and wealth increased. But hidden inside this growth was a powerful imbalance. Banks earned interest on money they created through lending, while depositors took on risk without sharing in the reward. If loans failed, banks had protection. If inflation rose, savers quietly lost purchasing power. The seeds of today's problems were planted early. Fast forward to the rise of central banks. Governments wanted stability, control, and the ability to manage crises. Central banks were given the power to create money, set interest rates, and act as lenders of last resort. On paper, this sounded like a safety net. In reality, it locked banks into a privileged position. When banks win, the system calls it growth. When banks lose, the system calls it a crisis and rushes to save them. Here is where things get uncomfortable. Banks are not just businesses. They are deeply connected to government policy. Interest rates are set in ways that favor borrowing over saving. When rates are low, banks can borrow cheaply and lend at higher rates. Meanwhile, savers earn almost nothing. Your savings account may show a balance growing, but inflation is quietly eating away at its real value. Think about your own experience. You put money in a savings account and feel good because the number goes up slightly each year. But have you ever compared that growth to rising rent, food prices, or healthcare costs? In many years, inflation outpaces savings interest. That means you are losing purchasing power while doing exactly what you were told was responsible. Banks, however, adjust their lending rates and fees to stay ahead. Credit is another powerful tool in this system. Banks encourage borrowing because debt is incredibly profitable. Mortgages, car loans, student loans, and credit cards all generate interest income. The longer you stay in debt, the more money flows to the bank. Minimum payments are designed to keep balances alive, not to help you escape quickly. Consider a credit card example. You buy a $1,000 item and make only the minimum payment each month. Over time, you may pay $1,500 or more for that item. The bank earns interest month after month, often at rates far higher than what they pay savers. The same dollar that earns you almost nothing in savings earns them a fortune in lending. Monthly maintenance fees, overdraft fees, late fees, wire fees, and foreign transaction fees all add up. Many people lose hundreds of dollars a year without realizing it. Banks design these fees to feel small and unavoidable. Individually they seem minor, but collectively they represent billions in profit extracted quietly from everyday life. One of the biggest turning points in modern banking came during major financial crises. Each time, the story followed a similar pattern. When those risks failed, the losses threatened the entire system. Governments stepped in to bail them out, using public money. Ordinary people lost jobs, homes, and savings, while banks survived and often emerged stronger. This pattern teaches banks an important lesson. If profits are private but losses are shared, risk becomes attractive. Economists call this moral hazard. You don't need to remember the term, just the behavior. When you know someone else will catch you if you fall, you jump higher. Banks jump higher with risk because the system cushions their fall. After each crisis, reforms are promised, new rules are written, oversight is increased, and politicians speak about accountability. But over time, pressure builds to loosen restrictions. Banks argue that regulations limit growth and innovation. Slowly, protections weaken, and the cycle begins again. The fixes fail because they never change the core incentives. One-click purchases and instant credit reduce friction, and friction is what once gave people time to think. Banks benefit when money moves quickly and emotionally rather than slowly and intentionally. They promise freedom and flexibility, but they often encourage people to spend beyond their means. Each transaction creates data, fees, and future interest opportunities. Someone pays, and it usually isn't the bank. When prices rise, the value of assets like real estate and stocks often increases. Banks and wealthy investors hold these assets, savers, who keep money in cash, lows. Inflation becomes a quiet transfer of wealth from cautious individuals to institutions positioned to benefit from rising prices. This is where many people feel trapped. They save and fall behind. They invest without understanding and feel overwhelmed. They borrow to keep up and sink deeper. The system feels confusing by design. Complexity creates dependence, and dependence creates profit. If finance feels intimidating, that is not a personal failure. It is a structural feature, but here's the twist most people never hear. The system doesn't require you to lose completely. It only requires you to play by default rules. Banks win most consistently when people don't ask questions, don't compare options, and don't understand how money actually flows. Awareness alone doesn't fix everything, but it changes how you move. Historically, people who understood money early adapted faster. They learned the difference between good debt and bad debt. They used banks as tools rather than treating them as guardians. This knowledge did not make them immune, but it made them less vulnerable. In recent years, cracks in the system have become harder to hide. Rising living costs, record household debt, and growing wealth gaps have forced more people to question old advice. Younger generations, in particular, are asking why doing everything right still feels impossible. That question is powerful because it challenges the story, not just the outcome. Some alternatives have emerged, from financial education platforms to new investment tools. But none are magic solutions. Every option carries risk. The key difference is intentionality. When you choose consciously, you shift some power back to yourself. When you act by habit, the system decides for you. So what are the real lessons here? First, money in a bank is not idle. It is working, just not for you. Second, debt is structured to be profitable for lenders, not liberating for borrowers. Third, inflation quietly rewards asset holders and punishes passive savers. These patterns repeat across history because the incentives rarely change. The warning is simple but serious. If you never learn how the system works, you will keep blaming yourself for outcomes that were engineered. That doesn't remove personal responsibility, but it reframes it. Responsibility includes understanding the rules before playing the game. The open-ended question is this: what happens when more people stop playing by default rules? Systems evolve when enough participants change behavior. Whether that change leads to reform, resistance, or something entirely new is still unfolding. If this video made you uncomfortable, that's a good sign. Discomfort often signals the edge of understanding. Use it as motivation to learn more, ask better questions, and think critically about where your money sits and why. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.